specializes in advising clients across an industry spectrum consisting of banking and financial services, NBFCs, manufacturing, hospitality, defense, power, aviation, real estate, construction, engineering, etc. Neeraj has been extensively involved in GST implementation projects across an industry spectrum involving financial and transactional impact analysis, changes in systems, IT processes, accounting, validation, and go-live assistance. Neeraj has significant experience in making representation before government and appearances before income tax tribunals and appellate tribunals. He has handled various VAT assessment proceedings and prepared submissions and represented clients. He has also handled several due diligences, restructuring, and strategic M&A deals from tax perspective and assisted clients in potential acquisition and divestment transactions. And lastly, myself, Dilpreet. I'm a partner of NeoDhruva based in Singapore. I have more than 20 years experience in the areas of tax compliance and consulting for local and multinational companies. I am a member of the Institute of Chartered Accountants of India, an associate of the ISCA, the local accountants body, and an accredited tax advisor with the Singapore Institute of Accredited Tax Professionals. My expertise includes, among others, planning for tax-effective acquisitions and disposals, assisting on tax due diligence exercises and post-acquisition tax structuring, inbound and outbound investments with a specific focus on India, advising on tax-efficient supply chain strategies and group reorganizations, international tax advisory and withholding tax implications, along with tax incentive negotiations and applications with relevant government agencies. I have worked on client matters across a wide range of industries, including consumer and retail, healthcare, life sciences, education, telecom, construction, manufacturing, and funds. Furthermore, I have also conducted the tax program at the Tax Academy of Singapore as a lecturer, and I regularly speak at taxation seminars and workshops. Prior to joining Dhruva, I have worked with large accounting firms including KPMG, Ernst & Young, and the erstwhile Arthur Andersen. With this, let me welcome Dr. Shukla, who will be giving us a macro overview on the Indian Budget 2024. Dr. Shukla, please.
Thank you for that introduction. Good afternoon, everyone. Thank you, FICCI Singapore and Dhruva. I'm happy to be a part of this knowledge roundtable on India Budget 24-25. As they say, content is king, but without the context, many a times it is worthless. Especially in economics and policy making, I think if you look at context, that is the compass that reveals how we can make sense of it all, especially something like a union budget for India. So let me first give you the broad context. There was this recent report from BIS, which basically said that the greatest danger facing the world is not terrorism, global warming, or the energy crisis. It is essentially out of control, unbridled government spending and debt levels, right? So as you all probably know, the US federal debt has now hit a number which is mind-boggling, $35 trillion, right? And the government is actually racking up about $1 trillion in debt every 100 days. And that is humongous, right? And similarly, if you look at some of these other large economies or emerging economies, debt levels post-pandemic have really shot up. And in a few cases, more than, say, 300% of GDP. Now, coming to the India-specific context, this was the first budget of the NDA-2, which was more of a coalition government. So while it was the same government, but the nature of the government changed, and it was more of a coalition government because there was some sort of altered electoral mandate. And the fear was in certain minds that the government could probably tilt towards populism, right? And we have seen just before the budget or around the budget, there were certain state governments, and even after the budget has been presented, they have come in with a lot of, say, welfareist, populist sort of announcements. And to just give you the context again here, state governments, as per an Access study, they are now spending about 1.8% of the GSDP on quasi UBI or direct benefit transfers, right? And this is humongous. This is really a large number. Also, what we need to keep in mind while evaluating the budget is that this is the second budget presented in just about 6 odd months. And you'll have another budget in another 6 months. So I think we need to keep this in mind, because the Feb budget was an interim budget because the government was going in for elections. The union budget that we saw was the full budget for the year. And in just about 6 odd months, another budget is around the corner. So that I think is something that we need to be cognizant of. Now, coming to budgets, I think over time, the budgets have become much more simpler, unlike in the past, right? So we're not really running around searching for how hundreds of customs duties for various products and segments have been changed. And we're not really running around to find which sector has got what and which one has lost. Similarly, the GST Council has also sort of taken a lot of mystery and a lot of excitement off from the budget. And there are not a plethora of excise duties being changed as in the past. One more important facet of the budgets is a lot more transparency is in these budgets, as some of you may recall. The earlier budgets, and then especially the previous decade or so, I mean, and then even before that, we had a lot of below the line items. A lot of subsidies were not really accounted for or not really presented in a very, very transparent manner. So we're all running around struggling to find the hidden details in part B of the speeches and even annexures to part A and B, right? So all of that mystery and then running around has been taken away. So if one were to look at the budget, basically it has reiterated the focus on key priorities of this government, right? I will probably talk about just two in detail, but let me just give you an overview in terms of what the budget has done. Basically, the budget has prioritized boosting job creation, advancing skilling. Rural economy has been a focus. There has been a laser-sharp focus on fiscal consolidation, which I'll probably talk in detail in a bit. And also, it has committed to remaining steadfast to quality expenditure, which is capital expenditure-led growth strategy. So I think if one were to look at the budget, I think this probably sums it up. It also attempted to put some money into middle-class pockets, which our tax experts will dwell upon in detail. There's some rejig in income tax slabs, etc., right? So the deduction limits and all. But I think from a broader perspective, what is really very important is the commitment to fiscal consolidation and then greater marksmanship on the budget numbers. I think that is a standout feature of this budget, as it has been for some of the past budgets presented by the finance minister. So what has the budget done? Basically, the fiscal deficit has been brought down aggressively to 4.9% from the earlier target of 5.1, right? This means that there is a reduction of 90 basis points in just 1 year. And please remember the figure that I cited for the US, for example. They're running a fiscal deficit of 6 to 7% of GDP, which is unheard of for a developed economy or for the US. And at a time like that, in terms of such a context, global context, the government has managed to reduce fiscal deficit by 90 basis points in just one single year, right? And also, they have brought down the revenue and primary deficits by 170 basis points respectively. And this is really, really important because if you were to look at the primary deficits and revenue deficits, they're not very often cited in popular commentary. It's only the fiscal deficit. But these are really important metrics for judging the efficacy of how the government really is spending and also incurring these deficits, right? So the question is, why is the government so aggressive in terms of fiscal deficit or fiscal consolidation? Why is fiscal prudence angle so important? So going back to the BIS context, right? They have cited debt as a big problem for the world. So has the IMF and some of these other agencies. And I just wanted to highlight a couple of metrics here. So if one looks at India's ranking when it comes to triple B minus cohort, right? So if I were to look at, say, just S&P, they rate about 137 odd countries, and India's rank is about 120. And that is something that we need to be very cognizant of. When I say general government debt, I mean the the debt of the central government and also the state governments put together, right? And the average for this cohort is about 38-39%. Whereas for India, it is north of 80%. So we are more than twice the triple B cohort, and that is a major issue. Also, only Greece in this subset has a higher general government deficit than India, and the number is about 143% of GDP. But please remember that the per capita income of Greece is $22,000 plus. Some of the other issues are, for example, the weighted average cost of borrowing across all maturities for Government of India is fairly high at about 7.3%. If I were to look at interest payments as a percentage of GDP, again, it is fairly elevated at 5.4% as compared to the emerging market peers. Or if I were to look at interest payments as a percentage of expenditure, it is, say, almost a quarter. And if I were to look at it as a percentage of revenue receipts, the revenues that the government has, it is more than 41%. And these are not very, good numbers. They don't really make India look very good when we talk about ratings upgrades and things like that. But having said that, let me add a couple of caveats. I think despite the high public debt ratio and some of the other statistics that I cited, the risk to debt sustainability is relatively very, very low as compared to the other comparable economies. The public debt that India has is almost entirely 98% denominated in local currency. And the maturity structure is also fairly long, so roughly 12 plus years. And we have fixed interest rates. So another important point is the nominal GDP growth number, that growth rate is higher than the cost of interest. So for example, the nominal GDP keeps growing at, say, 10, 11, 12%, whereas the numerator, which is the interest cost, grows at, say, 7 odd percent. And as long as that happens, the risks to debt sustainability are lower. Now let me address the second most important or the standout feature from the budget. I think is the laser sharp focus on infrastructure spending. One big change that has happened in this budget is the focus on soft infrastructure. And they're trying to harness the power of human resources and India's demographic dividend. And please remember, I think globally, the backdrop is, or the struggle for governments is to be able to really provide jobs, also quality jobs that pay a certain wage, which is palatable to these job seekers, right? I think this is the holy grail everywhere in the world. And it is heartening to note that the government put money where its mouth is, right? And come up with multiple schemes. I will not be really detailing those. You would have all read about it or heard about it, but basically they're trying to provide 1 month wage to new entrants in formal sector, benefiting roughly, I mean, the target is around 2 crore. And please remember, this is a medium term sort of a target. They'll also reimburse EPFO contribution to employers, basically trying to formalize this workforce. And they also plan to skill about 20 lakh young people. I think this is really, really important because what it will do is it will create an employable workforce. So the disconnect in India has been the employment and employability. And this endeavors to really correct that. And it will also help boost incomes indirectly by providing incomes and consumption by providing jobs. And therefore, to an extent, this will also probably address the skew that we have in India, which is more the trend of capital intensive nature of employment, right? So it will probably create more jobs and spur formalization of the labor force in India, which is the need of the hour. And this is probably the message that has come out loud and clear from the electoral mandate as well. The third bit, and staying onto the same theme, is the emphasis or reiteration of the hard infrastructure theme. The government has allocated about 11 lakh crore. It has reiterated that number. A lot of people think that they ought to have increased if they are emphasizing on infrastructure creation. But I think we are already a quarter past in this year. And basically to be able to spend 11 lakh crore in 9 months is going to be a challenge. And the number seems fairly decent, especially when you look at where the absolute numbers stand. So as a percentage of GDP is just 3.4%, remains unchanged from the interim budget. But in absolute terms, I mean, the scale has really gone up. And at that particular base, even maintaining that is something that I think is commendable. Multiple measures announced in the budget on infrastructure. So investment-ready plug-and-play industrial parks, trying to partner with states and private sector, also trying to emphasize rural connectivity, all-weather connectivity to some 25,000 rural habitations, etc. I think I'll probably just summarize this, and later on maybe we can have some questions if we have time. So the budget was the first litmus test for the new government in terms of fiscal discipline and the need to address the vulnerabilities at the bottom of pyramid, and then trying to do some income augmentation. So recall that India has been having a K-shaped recovery as in many parts of the world, right? And the government has done this fairly well. The balancing act, it's very cliched, but if you look at what the government has been able to do, is it's maintained fiscal discipline, it's reiterated that, and it's also tried to address the problems of the day, which is employment, skilling, and all of that, which will complement the PLI, and also over a period of time, over the next, say, 3 to 5 years, really try and address that. So the budget was neither radical as some people hoped, nor it was irresponsible. So it did not really, as some people feared, it did not veer towards populism or exaggerated spending and then trying to just throw money at the problem, right? It has just demonstrated the intense focus on key priorities of the government. And to my mind, the biggest takeaway, apart from the soft infrastructure focus, is that the risk of exaggerated pivot to high welfare spending has actually been allayed. And this is a very positive message for rating agencies, investors. The commitment to capital expenditure, and the FM really spoke about how she wants to maintain it for the next 5 years and continuing the fiscal consolidation part, and trying to harness the softer infrastructure, I think is the standout feature of this budget. And by doing that, I think it's lobbed the ball in the court of the RBI for the next policy push. So probably I'll stop here, and maybe we can take some questions later on in the latter part of this. Thank you so much for listening.
Thanks, Dr. Shukla, for insightful sharing. Let us now hear from Mr. Puneet Shah on the key direct tax proposals introduced in the budget and the implication of these changes. Puneet, please.
I have not used the mic. I am sure you can hear my voice clearly. What I will try and do, try and restrict my discussion on very relevant points relevant to the audience, so I will not bore you with any technical details. We'll just touch upon some of the high-level messages in the budget and some of the high-level changes which have happened, which are relevant and which are impacting most of the businesses in Singapore or in India. So again, as Dr. Shukla mentioned, the budget focuses on employment, skilling, MSMEs, etc., and the work on 9 focused areas to achieve Viksit Bharat, the developed nation, in next few decades. So that's the stated objective. There are hits and misses, more hits than misses, clearly. There were expectations about the budget, and some of those expectations are met, as I would deal with those, some of the provisions. There's an effort to simplify taxes, provide certainty, reduce litigation, and improve taxpayer services. It actually meets some of those objectives. There has been a real commendable effort to do that by the FM. We'll deal with some of those measures. There is an announcement to comprehensively review Income Tax Act 1961. So that's scary. We've been learning about this Income Tax Act for the last 40 years, and certainly the entire thing may change. Let's see what comes in. There was a proposal for direct tax code several years back. It never came into being. Let's see what does it mean by comprehensive review. Well, today we do not have any idea about that. The FDI and overseas investments, inbound and outbound investments, proposed to be some changes are proposed going forward to be simplified. Those announcements will happen as we move forward. Today, again, we do not have any sight of those possible announcements. One interesting announcement was VCC, Variable Capital Company. Very interesting. I'm sure they are taking clue from Singapore and some other countries. There could be a structure which could be allowed as VCC in India. Could be a game changer, especially for private equity investors and some of the investors who want a separate class of returns, separate class of voting, etc. Let's see. Today, it is not permitted in India. You have only one class, equity shares, or you could have preference shares, but you do not have VCC structures in India. And stamp duty rates to be moderated. Again, it's a good step in terms of ease of doing business. So I will not deal with all the provisions in detail. I'll just touch upon what was intended, what is being achieved. If there are any questions, I'll be very happy to deal with it in detail. So essentially, for individuals, there is no change of slab rates under old tax regime. So you have old tax regime, you have new tax regime. New tax regime, some slab rates have been amended. Some tax rates are same, the slabs are amended. It's a very, very nominal change, not worth even discussing. There was no need to tinker with these rates, but that's what is happening every year. And then the remaining one are dealing with the TDS and TCS provisions which are being rationalized. A good attempt, a very good attempt. So for example, you have multiple TDS rates of 5% for domestic payments, and there are some TDS rates of 2% when the payment is made in domestically. Now there are all the 5% rates are to be merged into 2% rates. So it's a good attempt. The purpose of TDS is not to collect taxes, but to track some of those taxable payments. So even if the rate is 2%, clearly you can track those payments. So that's one important amendment. There's a TCS which is there in the Income Tax Act. The credit was not available against your income. Now you can have TCS credit against TDS credit and vice versa. So that's a good attempt again. This is important. No prosecution for failure to deposit TDS within due date of filing return. I think this has become a big nuisance in India in terms of launching prosecution proceedings for even the smallest of TDS default. The amounts are not relevant, even though amounts are in lakhs, couple of crores. There are prosecution notices which you have seen, which are issued on directors, on companies, just because some TDS, there is some failure or there is some delay in depositing TDS out of cash flow issues or some unavoidable issues. It's a big thing. Clearly, to address that fear, the provision has been introduced that even though TDS is then deposited, before you file your quarterly tax return, TDS return, clearly the provision should not apply. Again, a very welcome change. And again, interestingly, if there is a TDS default, there was no time limit prescribed in the Income Tax Act for the foreign payers in terms of the TDS order to be passed by the tax office. For domestic player, it is 7 years. So similarly, they have now provided 6 years from the end of the year, which is again effectively 7 years for the foreign players as well, for non-residents as well. Interesting change, very interesting. Foreign companies are taxable in India if you have a permanent establishment in India. Then only you are taxable in the profits. The rate of tax was 40%, now it is reduced to 35%. An important welcome change again. I'm sure it's comparable with a global tax rate, which is in the range of 30 to 35%. India was outlier in terms of 40%, now it is 35%. So it's an important change. So any payment made to Indian branch or a permanent establishment, the TDS rate would be now 35% and not 40%. There was an equalization levy of 2% on the e-commerce transaction that is proposed to be withdrawn. So I'll not go into technical details, but there is a debate in terms of Pillar 1 and Pillar 2 introduction, OECD entire BEPS model, and this withdrawal of equalization levy of 2% is in that direction. Once you have Pillar 2 adoption by all the countries in the world, clearly equalization levy cannot continue, which was a unilateral levy by India on the e-commerce payment to the non-resident. So that's now proposed to be withdrawn. But unfortunately, there is no announcement about adoption of Pillar 2 approach by the FM. Hopefully, it will come in the next budget or very soon. Of course, there has to be a consensus by all the countries the world to adopt Pillar 2 approach, then only it will work. But it's a step, again, the first step to introduce Pillar 2 BEPS model in India by withdrawing equalization levy. There is a presumptive taxation introduced for foreign shipping companies operating domestic cruise ships in India. That 20% of their income would be considered to be profits, and on that the tax will be levied. Again, an attempt to simplify a regime. See, as you can see, there are enough and more measures to simplify the act, to rationalize the measures, to reduce tax burden. So I think it's a pragmatic in nature. Now the most important change, capital gains, and I'll try and again summarize for everybody's benefit. This was expected for last several years in terms of rationalization of capital gains tax levy. There are multiple rates. If you count, there would be at least 15 tax rates for different financial and non-financial assets in India, and there are different holding periods. So for shares, it was 12 months to become a long-term capital asset. For some property, it was 36 months. For some other assets, it was 24 months. So now they have rationalized. So listed securities above 12 months would be long-term capital gains. This is taxed at a concessional rate. All unlisted securities and other assets, 24 months. Only two periods, 12 months and 24 months. So it's again a very good measure. I'll not get into this, but slump sale, which is one of the way of selling business, the period is not changed. It has remained 36 months for the business sale or business as an asset to become long term. I think it's a miss. I think they have not realized it. Maybe they will change it or it will remain 36 months. The rate of tax, only two rates, 12.5% for long-term listed securities and all unlisted securities is 12.5%. All long-term is 12.5% now. So now for listed, it has now gone up from 10 to 12.5. But for unlisted, it has come down from 20 to 12.5. So very, people did not realize it on the first blush. People thought that it has increased from 10 to 12.5. But for unlisted and for properties, all other assets which are unlisted, It was 20% earlier, long term. Now it has come down to 12.5. A big relief to my mind. Of course, indexation benefit is not available. So when you compute capital gains, you used to get a cost of inflation, cost of index for inflation, which no longer be available. Maybe it's fair, but unfortunately, when you do a calculation, when you apply instead of 20%, 12.5%, but you do not get cost of inflation index, sometimes you may actually end up losing. So it would depend on the facts of the case. It would depend on your original cost, whether it was substantial or not. But to my mind, most of the cases you may gain. Short-term capital gains tax is increased from 15% to 20%. This is again mainly on listed stocks, units, etc. Right? And for most of the other assets, it is a slab rate. For short-term capital gains, whatever slab rate is applicable to you is applicable. But for listed, it is increased from 15 to 20%. Clearly, there is an attempt to discourage the trading speculation by encouraging short-term capital gains and encourage the long-term holding of the shares. One interesting amendment, again, I will not go into the technical analysis as to what is the impact, but a very interesting change has been made is unlisted bonds and debentures will always be considered to be short-term in nature. So even though you are holding debentures, which include NCDs, CCDs, all sorts of assets, and even though you are holding it for 5 years, it will still be considered to be short-term. So you don't know the rationale. This section was introduced a couple of years back for including MLDs, market-linked debentures. Now they have included all debentures, include NCDs, CCDs, all assets. And it will always be considered to be short-term, and therefore the higher rate of tax, which is a slab rate, would apply to these securities. So that's an important change, and we have just analyzed the impact of this change. There was one confusion in terms of promoters offering sale under offer for sale. They were taking a view that it is not chargeable to tax based on some interpretation of law, which was a loophole in the law. I think they have now plugged it. The intent was never to exempt offer for sale by the promoters as exempt from tax. So they have just plugged it by defining the fair market value. The plea was that I can't compute cost because of some provisions in the Income Tax Act. Now they have provided that FMV is on 31st January 2018 will be the cost, and therefore the cost has to be, the gain has to be computed and will be liable to tax. So something, the loophole which is plugged. So that was on capital gains tax, a very, very welcome step to my mind. Some people may gain, some people may lose. Angel tax, a very, very weird provision which was there on statute for last few years. In simple words, if either the Indian resident or a foreign resident infuses capital along with share premium into an Indian company, and if they cannot justify the valuation of share premium, especially startups, the tax officer had a right to include that entire amount as an income of the Indian company. So quite a weird, quite a unreasonable provision. It was used indiscriminately by the Indian tax office. So the amounts are in hundreds of crores, which got added into Indian companies' tax assessments, including startups. So startups were valued at huge numbers, and the tax officer just disregarded the valuation, saying, sorry, this is not justified. There are no profits not justified, and therefore entire amount was added as income. It's like a tax terrorism, to my mind. Clearly, there was huge hue and cry representations, and step in the right direction. The so-called angel tax is now abolished for all companies, not only startups, for all companies. But there is discrimination. So wherever it has happened in past, that continues. So that it is not retrospective. It is going forward with this. So where the addition of that premium amount in the income of the Indian company has happened, that litigation unfortunately will continue. quite a sad state actually. But that's how it is. It should have been, according to me, retrospective. And requirement to prove source of funds continues. So there is another, so this section is section 56. And there is another section, so that is abolished, but section 68 continues, which is a bit all-encompassing section, nothing to do with share premium. Any amount infused by a resident or a non-resident, you have to prove the source, the credit worthiness of the giver, of the lender, or of the investor. If you cannot prove the credit worthiness, that amount again can be considered to be income of the Indian company. That, unfortunately, that provision continues, and I fear that the tax office would continue their unreasonable action or a tax terrorism by using section 68 instead of section 56. But all in all, again, a welcome step. It's a very interesting change, and again, I'll try and summarize for everybody's benefit. Buyback of shares. Typically, Indian companies could distribute profits either by way of dividends or do buyback of shares. And the government and the rate of tax is 20% on buyback. So if I distribute 100 crores, I would pay, the company will pay 20 crores as tax. Now, government fears or government thinks that instead of declaring dividends, you are doing buyback of shares. Had you declared dividends, the recipient would have paid highest rate of tax, say 35%, as a recipient. While instead of declaring dividends of distributing profits, you are doing buyback of shares and distributing your profits and paying only 20% tax. So they are trying to, they think that the companies are misusing the provision of buyback, and therefore they are trying to plug this loophole, and they have completely amended, scrapped the provision of buyback of tax, the buyback tax, which was 20%, this is gone now. Buyback proceeds distribution will be considered to be dividends. So it will be taxed at an ordinary rate. So if I'm 35%, if I'm in 35% bracket, I will pay 35% tax plus surcharge, whatever. So it can go up to 39%. However, the amount I have invested in the company would be allowed to me as a capital loss. So if I have invested $10 million, I have got $30 million. So 30 million is my dividend income, 10 million would be my capital loss, which will be allowed against my capital gain in future. So some relief, but relief is capital gain, which is 12.5%, taxability is at 35%, right? So there is completely a mismatch. A very, very interesting amendment. Maybe buybacks were misused by most of the companies to declare profits instead of dividends. So just to plug that loophole. One small interesting point is the use of tax treaties. So for example, the tax treaties are not amended. India-Singapore tax treaty, India-Mauritius tax treaty. So can it be still considered to be capital gain under those treaties is a question to be considered. So India-Mauritius treaty, for example, or India-Singapore tax treaty, we can say, sorry, dividend is under the domestic law, but under tax treaties, should still be considered to be capital gains and taxed accordingly, or not taxed at all, if it is held before 1st April 2017, those grandfathered shares. Right? So that only time will tell whether the argument flies or not. That was on buyback. I just summarized the entire slide, and again, I've just added the loss-making company can now explore capital reduction or liquidation instead of buyback, which should still be considered to be capital gains because there are no profits. So they cannot be considered to be dividends. Last couple of slides. So the three main changes were capital gains rationalization, angel tax, we discussed abolition, and this buyback provisions. These are the three main provisions of the budget. To my mind, welcome. All three were quite welcome situation. Of course, except the buyback tax, which again depends the situation, whether it's beneficial or not, depending on if the foreign investor or domestic investor. Tax reassessment, very welcome, very welcome. Today, up to 10 years, the income can be reassessed. the assessment can be reopened for 10 years. The tax officer can go back 10 years. Now, only 5 years. If you see the second one, income above 50 lakhs. Income below 50 lakhs, 3 years remains virtually 3 years. But above 50 lakhs, instead of up to 10 years, it can only reopen for 5 years. Again, quite a welcome provision. Also, there is an increase in monetary limits for filing appeals. Good change. Instead of 50 lakhs, 1 crore, 2 crore is now increased to 60 lakhs, 2 crore and 5 crore. Below that amount, no appeal can be filed by the FICCI and similarly for the tax office. So again, quite a welcome change to reduce tax litigation. Interesting amendment again, when the residential property is let out, there was controversy whether the income earned by the landlord, is it income from house property or is it my business or business income? And if you offer it as business income, you could claim a lot of expenditure as tax reduction, reduce your income from house property. They have now clarified that it has to be offered as income from house property, with only few deductions allowed, statutory deductions allowed. So you can't claim every deduction expenditure which you incur on that property. There are Supreme Court rulings, etc., holding that if it's a systematic act of business, then it can be considered business income, otherwise income from house property. All that is now gone. Irrespective, will be income from house property. Yeah, just to simplify and make it predictable and certainty. MLD, I think we covered that. Interestingly, specified mutual funds also, if there is a gain, it will always be considered to be short-term capital gains. They have amended the definition of mutual fund, which is more than 65% of the assets into debt and money market instruments. In that case, it will be considered to be specified mutual fund, always considered to be short-term in nature, highest rate of tax for specified mutual fund. The controversy was whether any foreign mutual fund, so an Indian resident doing LRS, investing into a foreign mutual fund, can it be considered to be short-term in nature, or whether foreign mutual fund can be covered as a specified mutual fund. According to us, it should not. The mutual fund is defined under the Income Tax Act as per the SEBI regulations, while foreign mutual funds are not governed by SEBI regulations. So hopefully it should not be governed under this rule, and it will be long-term or short-term depending on the holding period. Very interesting amendment, very interesting. Gift of shares by companies not allowed. So last 30-40 years, people have done planning by gifting shares. So companies have gifted shares of the subsidiaries and whatever. Whether gift is specific to an individual by natural love and affection, how can company give the shares? So now I think the amendment is after 40 years, going prospectively again. So if there is a corporate restructuring and if gift is given, now it will be considered to be transfer and it will be taxable, number one. Now, how do you compute the consideration? Because there is no consideration, it's still a gift. There are sections like section 50CA or 50C or 50D, which are already there on the statute, which says that if the consideration is not determined, then it will be a fair market value of that asset on that day. So whether it's a property, whether it is shares, whether it is any other asset, the fair market value has to be computed. That would be the consideration. Very, very interesting change. Nothing right or wrong about it. They just feel, the legislature just feels that a corporate cannot give the shares. Oh, yeah. The last slide before I hand over to my partner for a quick summary of indirect tax provisions. A VSV scheme. I just thought I should specifically cover this again. Attempt by the Indian government to resolve the pending litigation, as we call it, VSV scheme, where if there are any past tax dispute, you can come clean or rather offer it for tax and save on interest and penalties. So if there's a scheme and if you concede the disputed amount to be taxable and do not and withdraw your claims, you'll pay 100% of the tax. If you do it before December, after 1st January 25, 110%, and you are done. And that is mainly for main appeals. Just do it and no further questions asked. And in case of any other appeal, you pay 25% and 30%. So again, an attempt. This was a second scheme. The scheme came a few years back, and now there's a second scheme. That was quite successful. We did a lot of work for our clients in that case. So similarly, there is an attempt, there is an expectation that there will be a good response to this scheme as well. That's it on direct taxes. I'll try to cover all the key amendments, and I'll be happy to answer any questions if you have at the end of the presentation. I'll hand it over to my indirect tax partner, Neeraj.
Thank you, Puneet.
Yeah, Neeraj.
Yeah, thank you, Puneet. In indirect tax, we will be covering the changes made in the Customs Act and the GST proposals. Some of the proposals were announced before the budget, but some of the key ones are the ones which will take up for the presentation. So if you can go to the next slide. Customs, again, the theme has been simplification and rationalization of rates. India is pushing to become a manufacturing destination. With this purpose, there are a lot of instances where there is an inverted duty structure, wherein the rate of duty on finished goods is lower than the rate of duty on raw materials. So the idea is to reduce the custom duty rates on raw materials and make it more enticing for people to come and set up a manufacturing facility in India. And the government has, in this budget, looked at host of sectors, be it critical minerals, precious metal, renewable sector, wherein they have sought to rectify this anomaly. They have also announced that in next 4 to 6 months, a comprehensive review will be undertaken of the custom tariff structure so that it is simplified, and wherever there is an inverted duty structure, the same should be addressed so that again it becomes an attractive manufacturing destination. Next slide. These are some of the proposals, as I mentioned, which were announced relating to GST. The timelines have been relaxed. As we all know, GST got introduced in 1st January 17, and the implementation phases had its challenges, and we are still seeing the effects of those challenges. So the government sought to provide a relief where the timeline which is mentioned for taking input tax credit, which was 6 months end of the financial year, that has been relaxed for the first 3 financial years, and anything which has been taken till November 2021, the delay provisions will not be applicable, and the company will continue to get the benefit. Another provision which we have seen in the GST law, which is consistent with what they are doing in customs, is that if there is any export duty being levied on export of any goods out of India, means the intention of the government is to restrict those exports. So far, while the export duty was payable under the customs law, but a GST refund was available to the companies as a refund is available for any goods exported out of India. In order to sort of plug that aspect, the government is now amended the provision to say that where an export duty has been levied under customs, the GST refund will be not available. And in effect, the company will be required to pay the GST, and it will going to make more costly for them to export, which is the intent behind levying the export duty. If we move to the next slide, again, some rationalization for the period for which the demand can be raised. We have seen different periods which are available under section 73 and 74. Now, both of them have been collapsed, and instead of 33 and 54 months, now 42 months has been made as one consistent period within which a show cause notice has to be issued by the department. And the idea is again to simplify and not have multiple provisions for making any demand. One welcome provision that has been inserted, as we have seen many instances where the department is sort of in an overdrive, issue summons for the senior management or a senior team member to be present for recording his evidence. So the provision now allows any authorized representative to appear. So it is not necessary that the person to whom the notice has been issued, he has to come, but he can authorize somebody. It could be a legal counsel, it could be a chartered accountant, or it could be a employee of the company who can be authorized to appear before the officer. So this will again sort of bring ease of business, and hopefully the flurry of notices which are being issued left, right, and center, it can be controlled by at least making or getting the relevant person to appear before the authorities. Again, relief has been given whenever an appeal has been filed. There is a pre-deposit that needs to be done. So the earlier limits were 10% and 20%. That has been brought down to 10% each. And even the total quantum has been reduced from 25 and 50 to 20 crore. So this will at least ensure that a large sum of money is not sort of locked in with disputes. As we all know, it takes multiple years for the dispute to be resolved. So this will bring relief in terms of not having large sums of money being blocked with the department till the appeal is decided by the tribunal. An amnesty scheme has also been introduced under GST, like we saw in income tax. Again, this is for the first 3 financial years when the GST got introduced. So if the tax demand is paid, while initially the date which was announced was 31st March 2025, but the recent amendments have suggested that the government is going to notify a fresh date. The sum of it is that if you pay the tax demand, then a complete waiver on interest and penalty will be given. So this is going to be providing a lot of relief to the industries where there were a lot of issues in the initial period of implementation, and honest mistakes have been made by the companies. And this is a chance to sort of put that behind and not needlessly continue to litigate. Especially the interest and penalty waiver will be very critical to take the benefit of this provision. Anti-profiteering provisions was something which was intended to ensure that the suppliers do not take undue advantage when GST provision got introduced, because a lot of rates were reduced. Now it has sort of lived its time, and it's almost 7 years when the GST got introduced. So it is important to now bury this provision, and therefore the government will sort of notify a date beyond which no anti-profiting applications can be filed by the department. If you look at some other recommendations which have been announced, I will take the key ones here. One is often we see intercompany loans being given between holding and subsidiary or sister subsidiary companies, and the department has been raising a question to say that the loan amount itself could be subject to tax, which of course is not the right interpretation of the law. And the circular now clarifies that point and says that the loan amount cannot be subject to tax. But yes, if there is any fee being charged from one company to another, then that amount could be subject to tax. But the entire loan cannot be put through the rigors and can be taxed under GST law. This is another welcome clarification issued by the government, where there is a transaction between 2 related parties. It could be domestic or foreign and domestic. And if the recipient, which is the Indian company, is entitled to full input tax credit, then whatever value is declared by the supplier will be accepted by the department as the arm's length value. Assuming no value has been declared by the supplier, still the department will accept that as nil value, given the fact that the recipient company would have been entitled to full input tax credit. Now, we have seen a lot of disputes in past few years, especially relating to secondment arrangements or use of trademark, brand name, etc. Now, the department had its own benchmark to tax these transactions. Now, if the company is entitled to full input tax credit, it is going to provide significant relief from litigation under the GST law, because whatever value is declared will have to be accepted by the department. The last one again is relating to corporate guarantee. Corporate guarantees are being given to extend loan facilities to either holding or subsidiary companies. A lot of debate has been happening in last 5 to 7 years. A valuation rule got introduced in last October 2023, which sort of reignited the entire debate, because the rule proposed to put a value of 1% of the guarantee amount as the value on which GST should have been charged. Now, wherever the credit is available, the question came again on the point as to whether 1% needs to be applied or not. So that is something which got clarified by the circular to say that if the credit is available, then even if you don't apply the benchmark of 1% or you don't charge any specific fee, both the scenarios, it should be acceptable to the department. But if the full ITC is not available, then the companies needs to charge 1% of the guarantee amount. I mean, 1% of the value should be considered, on which 18% GST will be charged. Now, this will lead to increase in cost because the recipient is not entitled to input tax credit. But this is how, and this provision has also been challenged before the High Court, where the 1% adoption of 1% has been challenged to be arbitrary. So let's see how the court decides on this matter. But wherever the credit is available, at least in those cases, there should not be any more dispute by the department. Another clarification given in context of corporate guarantee, where the guarantee is being extended by the Indian company for an overseas company. Now, this was considered as an export service transaction on which ideally no GST should be applicable. But one of the conditions to be satisfied for it to be considered as an export transaction, that the consideration should be received in foreign exchange. In many cases, we have seen that while the guarantee is given, there is no separate consideration being charged by the domestic company. And therefore, the question was that whether the test of export of services would fail in those cases. The circular has clarified that even if no consideration is being received, it should still continue to get the benefit of export of services. So again, a welcome clarification, which hopefully will not result into more litigation on this point. So these were the few key proposals under the GST law, which we have covered. I'm happy to take if you have any questions on that.
Thanks, Yash. Thanks a lot. I think maybe at this point we've come to the end of the presentation proper, but we'll be happy to open the floor for any questions. Any question here, specifically Puneet or for the economist or from Indian tax perspective?
Short question on this unlisted debentures. Whether the short-term capital gain will apply at the time of conversion of debenture to
Conversion into equity, no, but that is not transfer. That remains. That remains. If it is not, if it is considered to be transfer, it would be full rate of tax. So yes, but it's quite a provision. Unexpected.
One question on this export of goods. So Mr. Neeraj mentioned that there will be export duty.
Neeraj, are you able to hear?
Yes, I can hear that.
Okay, great.
Yeah, you made a point that with respect to export of goods, there will be custom duty, export duty, and also the input credit on the GST will not be available. So won't it be a double whammy for the exporters?
So
Exports more and more credit.
So, export duty on export of goods is not applicable across the board. It is very few specific goods which the government wants to prohibit the exports. The idea of levying otherwise 99.99% of the goods do not suffer any duty. They are free from any custom duty. A levy of custom duty on export good is considered when the government wants to discourage the exports. So there are two mechanisms which are available. One is a prohibition, an outright prohibition where you cannot export at all. The second is where they levy a duty in order to make it more costly to export out of India. So the provision of GST of not giving refund is only in those cases where the government has levied an export duty under the customs law. So you're right, it is a double whammy, but the idea was that they want to make it costly for export of those goods, and therefore they do not want to give the benefit of refund of GST input tax credit.
And one more question was with respect to the import tariffs. I think India now has some of the highest import tariffs in Asia. So you mentioned that a review is coming up with this respect. So are they talking about some rationalization on that front?
So what we see the rationalization would be for the raw materials, not so much for finished goods, because as I mentioned, they want to ensure that people come and invest in India and manufacture in India. And there are many instances where the import duty on the finished goods is lower than the raw materials. So they want to address that situation by reversing the trend and make the import of raw materials cheaper as compared to finished goods. So if I can just take one example which came in this budget where they made a departure from this practice, and the the finance minister mentioned in her budget is a case of mobiles. So if you recollect, India imposed a tariff of 20% on mobile, which has also been challenged by Taiwan and other countries before WTO. The idea was that the government wanted to encourage the entire ecosystem of manufacturing of mobile to be done in India. And last 4 to 5 years have seen significant export of the finished product happening from India. So keeping in mind that reality, the FM actually reduced the customs duty from 20% to 15%. And she made a mention of that fact that now that this ecosystem has been developed, they want to benefit the end consumer in India, and therefore the basic custom duty on mobile has been reduced. So if you see, the tariff measures are being used to encourage or discourage a certain way of doing business.
Any other questions from the floor? Okay, if no more questions, then I think we can bring the session to a close. Thank you, speakers, Neeraj, Dr. Shukla, and thank you everyone for your time today. Thank you very much.
Thank you.
Thank you.